continue with our lecture series on the conceptual framework for financial reporting. This little lecture is going to be based on the elements and the definitions of those elements. Now, when you're discussing elements, you need to think about, first of all, financial position, which is a wealth concept, which shows all the assets and liabilities that the company has built up since its inception. Then you'll think about financial performance, which is income and expenses over a period. That is financial performance. So let's start off with financial position. Here I want you to think about the accounting equation. That is assets equal owner's equity plus liability. So as discussed now, this is a measure of financial position, and that will be at a specific date, what we used to call the balance sheet concept. Financial performance, however, that is over a period, and here we are looking at what eventually will land up in equity, namely profit. And profit is equal to income minus expenses. And what are the elements here? The elements are income and expenses. Now, this is a measure of financial performance, and this will be over a period. Usually we'll say the financial performance for the year 2012, okay, over a period. Remember that at the end of this, profit is eventually closed out or accumulated every year into an equity account. Sometimes we call that retained earnings or accumulated profits. Now, the equity account is a financial position concept, whereas the profit, the income minus expenses, is a financial performance concept. So quickly, under financial position, we have three elements, namely assets, liabilities, and equity. Under financial performance, we have income and expenses. So just to run through the definitions of each of these briefly, I will then discuss each of them separately. So under financial position, I have a resource controlled by the entity, resulting from past events, and there is an expected inflow of future economic benefits from those resources. A liability, here we have a present obligation resulting from a past event, and the settlement of which is expected to result in an outflow of resources embodying economic benefits. Equity, quite easy, is what we call the residual interest, namely assets minus liabilities. Financial performance, the wording for income and expenses is quite lengthy in the framework. We will look at that in detail later, but in the core concept here is either an increase in assets or a decrease in liabilities for income. For expenses, we are looking at either an increase in liabilities or a decrease in assets. Take note, financial performance, both income and expenses are defined in terms of assets and liabilities. So it's an asset and liability approach that drives the element definitions. Okay, so in detail now, the asset definition, let's have a look at that first. The asset definition, three headings: resource controlled by the entity, resulting from a past event, and there is an expected inflow of future economic benefits. Let's discuss each of those headings quickly. Resources controlled by the entity. What is a resource? It is access to future economic benefits. What is control? Well, control is the right to restrict access to those future economic benefits. There must also be a past event, which, let's call that an entitling event, an event that entitles you to access those future economic benefits. And then the most important core concept is this future economic benefit, the third heading. What is a future economic benefit? It's a potential to contribute, either directly or indirectly, to the entity's cash flows. Please also remember that you will need to take into consideration time value of money, but we'll discuss that in a bit more detail. So, how would future economic benefits flow to the entity? Well, that would happen in a number of ways. First of all, those resources or future benefits may be used in the production of goods or services that are then later to be sold. They might be exchanged for other assets. They might be used to settle a liability, or they might be distributed to equity participants or owners. Moving on now, a liability definition. The three core parts of this definition are: there must be a present obligation resulting from a past event once again, and the settlement of that obligation is expected to result in an outflow of resources embodying economic benefits, future outflows. Let's look briefly at each of these three little headings. Present obligation. Well, an obligation could either be a legal obligation or a constructive obligation. A legal obligation would result from a binding contract or some type of statutory obligation. You also may have a constructive obligation where the company created a valid expectation that it would behave in a certain way in order to comply with best business practice, or just to look after its reputation, etc. The best example I can think of here is I might be an international oil company, and I might have multiple operations, and two new operations arise. The first one is I'm going to drill in the North American coastline, and I'm going to try to get oil. Now, North America, very well developed country, strong statutes, and what's going to happen there, in order to get the license or the right to drill, you would have to comply with certain agreements and certain legislation. And I can promise you that the American government will require that drilling company, our drilling company, to restore that drilling site to its original ecological state once we've finished with the drilling and obtained our oil. So that would be a legal obligation, because we would need to comply with a statutory obligation. But now we go down, let's say we go off the coast of Somalia. Somalia, not a very functional government. The chances are we would probably not even have any legislation in place governing that oil drilling. So there, what we would rely on is, have we created a valid expectation that we would still restore the site to some type of ecological original point? Well, yes, we would, because we're an international oil company. We've got it in our policies to keep Greenpeace and our investors happy, and to be of social importance and social relevance. Yes, we would create the valid expectation that we would restore that site to its original ecological essence. Now, that is not due to law, but it's because you've created a valid expectation. Therefore, that's a constructive obligation. Okay. So, present obligation resulting from a past event. Here we're looking at some type of obligating event. And what I always like to talk about here is some type of what many academics call the avoidance test. So, is there a present obligation resulting from a past event? Well, let's look at that date that we're talking about, my reporting date. If I have created an obligation, I would not be able to avoid some type of settlement. Even if I closed the company down today, the liquidator would need to pay out that creditor or that, well, the other party to the obligation. If I closed the business today and I did not have to go forward and pay out that obligation or settle that obligation, well, then it's not an obligation in terms of the liability definition. The third point now, present obligation, past event, and the settlement is expected to result in a future outflow. That's pretty straightforward, but once again, please consider the impact of time value of money, and that you will have to present value any future outflows. Okay, quick discussion about obligation versus a future commitment. Remember, a present obligation, there will always be some type of consequence if you fail to honor that obligation. I.e., if you do not honor your obligation, there will be a penalty or some type of settlement required, and there will be a outflow of resources. Okay, so you will have no right to avoid settlement. That's a present obligation. Future commitment, however, well, there you would not have. You can easily avoid future settlement. So the best example is the management of this company will decide to acquire assets in the future. It's a management internal decision that is made on reporting date. Please take note that the very next day, if management decided to change their mind the day after the reporting date, well, there would be no obligation because they have not yet signed a contract with the supplier for that asset. So then there would be no present obligation. When it would be a present obligation would be the day they sign a contract with the supplier, or if alternatively, if there's no contract, they receive the invoice or take delivery. Then yes, there would be a obligation. Okay, the liabilities may be settled in a number of ways. The most common is payment of cash. Alternatively, other assets may be transferred, or services may be provided in settlement of that obligation. Another alternative is that our current obligation may be replaced with another obligation. If we don't have any of those means available, sometimes we may settle our liability or extinguish the liability by converting it to equity. Multiple other less used extinguishment options are available. For instance, creditors may waive or forfeit their rights to the money that they are owed. Okay, so that's a brief overview of assets and liabilities. What you also need to just consider, some additional notes, is that you must consider time value of money. So if we're discussing assets, we'll be looking at future economic benefits. If we're discussing liabilities, we'll be looking at future outflows. So if those were contractual cash flows that either were going to be received for assets or paid for liabilities in the future periods, let's put those future economic benefits on a timeline. Now we all know that 100 Rand in 3 years' time is not worth 100 Rand today. So what we would need to do is we would need to take that future actual nominal amount and discount it back to the present value. Now, the discount rate is a whole another lecture by itself, and you'll look at that more in your management accounts and your finance subjects, but you'll have to discount it, that figures, and all those figures, back to the time value of money, present value today. Okay. Last note is sometimes the legal form of transactions does not represent the economic reality. So what we need to always look at is we need to look at substance or economic reality over legal form. The best example here is a lease. So you go into a car dealership and you buy your BMW. Okay, that BMW you were not able to pay cash for, so you went to the bank and you got a financing agreement. Now legally what will happen there is the bank will own the vehicle until you have paid it off. So legally you don't own it, you're paying a lease or a right of use payment to the bank. But in substance and economic reality, you have purchased that vehicle and you've obtained financing from the bank. The legal form was just there to give the bank extra security. So the substance of a form there is you purchase the asset, you bring the assets on and you raise the relevant liability. The legal form was you were just leasing it, renting it. So that's a clear example of you have to apply substance and economic reality over legal form. Equity definition. So equity now is defined as the residual interest in assets after deducting all liabilities. So in essence, equity is equal to assets minus liabilities. That's quite easy. Later on, you'll see, especially when you deal with things like financial instruments, the distinction between equity and liabilities can become quite tough, but the basic core concept is this: assets minus liabilities. Okay, moving on to financial performance now. Let's have a look at income. Remember, income I discussed with you was either an increase in assets, okay, or a decrease in liabilities, and that results in an increase in equity. Let's just go through the big formal definition quickly. So here, increases in economic benefits during the period in the form of inflows or enhancements of assets, or decreases of liabilities that would result in an increase in equity. Please just note, other than those relating to contributions from equity participants. So a share issue is not an income. That's a direct transaction with equity participants. Some notes on income. The framework is quite clear. It encompasses both revenue and gains. Revenue is differentiated from gains conceptually due to the fact that it is income from the ordinary business activities. Gains, however, still have the same nature, increase in assets or decrease in liabilities, but they are just not from ordinary activities. Example of gains that are not revenue, well, that would be profit on sale of non-current assets, and also it includes unrealized gains such as fair value adjustments to financial instruments or revaluations to PPE or fair value adjustments on investment property. expenses. Expenses are decreases in assets or increases in liabilities that result in a decrease in equity. The big detailed written out form in terms of the framework: decreases in economic benefits during the period in the form of outflows or depletions of assets or incurrences of liabilities that result in a decrease in equity, other than those relating to distributions to equity participants. So if there was a dividends paid, that is not an expense, that is an equity transaction. Okay, because it's directly with shareholders. Great, I hope you've found this useful. Please just remember, assets. Okay, assets are resources controlled by the entity, resulting from a past event, and from which there will be an inflow of future economic benefits. Liabilities are a present obligation, resulting from a past event, and from which there will be a outflow of resources embodying economic benefits. Let's just write FOF for that. Okay. Equity is equal to assets minus liabilities. Income is equal to increases in assets or decreases in liabilities. And expenses are equal to decreases in assets or increases in liabilities. Please make sure that you know those. It's very important for your exam technique, for your work, and when you're writing out memorandums or opinions for clients in the real world. This is what the rest of your accounting is going to be built on. Make sure you have learnt it, and from that will flow understanding. Thank you.